There's a number that quietly separates most Americans from actual wealth. Not income, not debt, not credit score, a different number. And chances are you've never crossed it. $10,000 in liquid savings. Sounds modest, right? A few months of rent, a used car, a medical emergency that doesn't end in bankruptcy. But here's what nobody tells you. Most people will never see that number sit still in their account. Not because they don't earn enough, because the system is designed to make sure they don't. Let me show you how. In 2019, the Federal Reserve published a study. They asked 40,000 Americans a simple question. If you had an unexpected $400 expense right now, could you cover it without borrowing money or selling something? 40% said no. Not $4,000, 400. Now here's where it gets interesting. That same study found that households with less than $10,000 in liquid assets behave completely differently than households above that line. Different spending patterns, different debt cycles, different financial outcomes for the rest of their lives. 10,000 became the invisible threshold, the number where financial behavior fundamentally changes. But why 10,000? And why does crossing it feel impossible for so many people? Let's start with what $10,000 actually represents in the American economy right now. The median rent in the United States is around $2,000 a month. Health insurance deductibles average $4,500. The average car repair costs between $500 and $1,500. A broken furnace in winter, $3,000 to $5,000, depending on where you live. $10,000 is roughly the amount you need to absorb life's normal catastrophes without spiraling. It's not wealth, it's a buffer, the financial equivalent of shock absorption. Here's the problem. Saving $10,000 requires not spending $10,000, and the entire consumer economy is engineered to prevent exactly that. Think about it. Every financial product, every app, every service you interact with is optimized to keep money moving. Credit cards offer rewards for spending, not saving. Buy now, pay later schemes make purchases frictionless. Subscriptions auto-renew. Algorithms show you things you didn't know you wanted 5 seconds ago. Even your bank account is designed for flow, not storage. Interest rates on savings accounts have been near zero for over a decade. You're not rewarded for holding cash, you're punished. Let me walk you through what happens to someone trying to save $10,000 in the current system. Say you earn $50,000 a year. After taxes, that's roughly $38,000, or about $3,000 a month. National average. Rent, $2,000. Utilities, phone, internet, $300. Car payment and insurance, $400. Groceries, $400. Gas, $200. Student loan minimum payment, $250. Health insurance, $200. You're at $3,700 a month before you've bought anything discretionary. You're already underwater by $700. But let's say you're disciplined. You cut subscriptions, you meal prep, you don't go out, you squeeze $200 a month into savings. At that rate, it takes you 4 years and 2 months to reach $10,000, assuming nothing breaks, no medical bills, no car trouble, no wedding to attend, no family emergency. 4 years of near-perfect execution to reach the starting line of financial stability. Now here's the part that makes this worse. While you're slowly building toward $10,000, the cost of not having $10,000 is actively draining you. Overdraft fees, $35 every time you miscalculate by $10. Late fees on bills you had to delay, $25 to $50 each. Payday loan interest when your car breaks down, 400% APR. Credit card interest because you couldn't pay the full balance, 22% average. There's a term for this, the poverty tax. It costs money to be broke. A 2021 study by the Financial Health Network found that low-income Americans pay roughly $10 billion a year in fees and interest that wealthier households never encounter. $10 billion, just for not having a cushion. So you're trying to save while simultaneously being charged for not having saved yet. It's a tax on momentum, a penalty for starting from zero. Let's talk about what happens if you do make it across. Something strange occurs once you hit 10,000 in liquid savings. The math of your life inverts. You stop paying overdraft fees because you have a buffer. You stop carrying credit card balances because you can pay in full. When your car breaks down, you pay cash and avoid 18% interest on an auto loan. You can wait for sales, negotiate prices, walk away from bad deals. 10,000 doesn't make you rich, it makes you expensive to exploit. And here's the irony, the financial system starts treating you better. Banks offer you higher credit limits, lower interest rates, better terms. You qualify for rewards cards that actually give you money back. You become profitable in a different way, not as a fee generator, as a borrower they want to keep. It's the same person, same income, same job, but now the system bends slightly in your favor instead of against you. This is why 10,000 isn't just a number, it's a phase transition, like water turning to ice. Same molecules, different state. But here's the uncomfortable question nobody wants to ask. If $10,000 creates this much separation in outcomes, why is it so hard to get there? Is it individual failure, bad choices, lack of discipline? Or is it structural? Let's look at wage growth versus cost of living over the past 40 years. In 1985, the median household income was about $23,000. Adjusted for inflation, that's roughly $60,000 today. The actual median household income right now, $74,000. Sounds good, right? Wages went up. Except rent has increased faster than inflation. Healthcare costs have increased faster than inflation. Education costs have increased 900% since 1980. Childcare costs have increased 800%. The things you need to survive have outpaced the money you earn to survive. And here's the kicker. Productivity has increased 70% since 1979. American workers are producing more value per hour than ever before, but wages haven't kept pace with productivity. That gap, that difference between what workers produce and what they're paid, has been redirected upward. Corporate profits as a percentage of GDP are at historic highs. Shareholder returns are at historic highs. Executive compensation is at historic highs. The money exists, it's just not reaching the people trying to save $10,000.
So what happens to an economy where half the population can't clear the $10,000 line? Fragility. Every recession, every market shock, every unexpected crisis hits harder because there's no cushion. Households can't absorb the impact, they cut spending immediately. Businesses lose revenue, layoffs accelerate, the spiral deepens. We saw this in 2008, we saw it again in 2020, and we'll see it in the next downturn. An economy built on consumer spending needs consumers who can spend. But if those same consumers are perpetually treading water, never building reserves, the system becomes brittle. One bad quarter, one supply chain disruption, one interest rate hike, and millions of households tip into crisis mode. It's not sustainable, but it is profitable. For now. Here's where it gets darker. There's an entire industry built around people who can't save $10,000. Payday lenders, rent-to-own furniture stores, title loan companies, subprime auto financing, overdraft programs. These aren't fringe businesses, they're billion-dollar industries. Check Into Cash, the payday loan company, has 2,600 locations. Rent-A-Center has 2,000 stores. Advance America has 2,400 branches. They exist because demand exists, and demand exists because people are $50 short on Thursday and payday is Monday. The margins on these businesses are insane. Payday loans can carry effective APRs above 300%. Rent-to-own contracts can cost 3 to 4 times the retail price of the item. Bank overdraft fees cost the institution almost nothing, but generate $33 billion a year in revenue. Think about that. $33 billion in profit from people who don't have enough money in their account. This isn't accidental, it's a business model, and it only works if a large portion of the population stays below the $10,000 line. Now let's zoom out even further. What does it mean for a society when financial stability is this hard to achieve? It means delayed life decisions. People wait longer to get married, longer to have kids, longer to buy homes. Not because they don't want those things, because they can't afford the risk. It means healthcare gets skipped, preventative care, dental work, mental health treatment, all delayed until it becomes a crisis, which costs more, which makes saving harder. It means talent gets wasted. Someone who could start a business, go back to school, take a risk, can't because they're $3,700 into a $3,000 month. And it means political instability, because when half the country is one bad month away from disaster, they vote differently. They trust institutions less. They're angrier, more desperate, more willing to believe that the system is rigged, which, depending on how you define rigged, it might be. Here's the thing that keeps me up at night. $10,000 is not a lot of money. It's a rounding error in a federal budget. It's less than what some people spend on a vacation. It's 3 months of rent. But for tens of millions of Americans, it's unreachable. Not because they're lazy, not because they're irresponsible, but because the math doesn't work. And the people who designed the math know it doesn't work. They know that credit card minimum payments are calibrated to keep you in debt longer. They know that subscriptions auto-renew because you'll forget to cancel. They know that overdraft fees punish the people who can least afford them. This isn't conspiracy, it's business. Optimized, A/B tested, algorithm-driven business. So here's the question I'll leave you with. If $10,000 creates this much separation, if it changes financial behavior, outcomes, and opportunities this dramatically, and if the majority of people can't reach it under current conditions, what kind of economy are we actually building? One that rewards savings, or one that requires spending? One that creates stability, or one that profits from instability? Because right now, we've built a system where financial security is technically possible, but functionally difficult for most people. And the longer that gap exists, the more it widens. You can call it the $10,000 rule, or you can call it what it really is: a sorting mechanism, separating those who have margin from those who don't, and ensuring the distance between them grows. The number isn't the problem, it's what the number reveals. And what it reveals is worth thinking about.